As a stock market investor, there's absolutely no way an ordinary value investor can evaluate tens and thousands of listed companies individually. But looking closely into it, what if we tell you that we have a method that can narrow these complexities down into a short list of better than average companies for you guys to invest in by looking at some key aspects of the game? Just like an intelligent chess player finds the correct move at the appropriate time, the intelligent investor needs to filter out those stupid moves and look for the best move. So let us show you guys a strategy that has been very helpful for the majority of billionaires out there. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. So how do you actually find those great investment opportunities in the stock market? An ordinary investor might tell you that you need to head straight towards your cell phone and check out the Twitter accounts of some famous investors and simply target the stocks they are going after. Or you can go stock hunting on YouTube to check some quality stocks out there, right? This is not the ideal or the best way of looking out for the best stocks. As Warren Buffett puts it, you can't buy what is popular and do well. While looking for companies to invest in, there are many important things that a value investor needs to consider. For example, the company should be cheap, it should have a good business model, it should have a competitive advantage, and it should not have debt more than it can manage. Now, you might be thinking there are many companies with those characteristics, but fear not, because we're going to simplify the list. Now, some of these important things you can check in a few seconds, but others can take days or even weeks of your precious time to get some understanding. So what we've found is that some great value investors out there simply look at those fast to check variables first, and they simply exclude the companies which do not fulfill them. Now, this strategy can save up a lot of time for value investors, and you can focus all of your efforts on better than average opportunities. No one is going to argue that we all want our hourly wage to be as high as possible. Okay, now the question arises, why should you guys believe in what we're saying, right? Back in the 1950s, when Warren Buffett started his investing journey, he went through many books such as Moody's Manual in search of some great investing ideas. Now these books have thousands of pages, but in today's world, with the working class striving to work more than 8 hours a day, everyone can't go through all of these pages. But you and your fellows don't have to go through those pages because we are living in the digital age. Today, many investing platforms can help you find those quality stocks. Let us show you guys how it's actually done. Step 1. Valuation. Imagine you see a brand new Lamborghini, which is looking stunning in its yellow color. Do you want to buy it? Now this is a trick question because there's no way you can actually answer that without knowing the price of the car. As Howard Marks said, there is no such thing as a good or bad idea regardless of price. We think that nowhere other than in the stock market are people so ignorant about the fact that how much are they actually paying for the things that they are buying. Remember what the legendary hedge fund owner Peter Lynch says? Although it is easy to forget sometimes, a share is not a lottery ticket, it's a part ownership of a business. Now, as an intelligent investor, you should always ask yourself, how much does a 0.0000001% ownership in this company cost me? To continue with that analogy, including the Lambo, it isn't always the guy who owns the Lamborghini who is successful in the stock market. More than often, it is the guy owning the Toyota at a reasonable price who is always outclassing the market. So you need to ask yourself before betting on a stock is how much this costs you. Remember what Charlie Munger, the right-hand man of legendary Warren Buffett, said about buying stocks? We have 3 baskets for investing: yes, no, and too tough to understand. You guys can actually use the P/E ratio, which is the price to earnings ratio of a company, to make sure that you're not paying more than what you're actually earning through that company. Now, we need to understand that by excluding some companies, we're going to miss out on some opportunities. But still, it is also true that we're going to avoid many mistakes. And once the costlier companies are filtered out, we're going to be left with 20% of the universal companies. We're one step closer to finding those great opportunities. But hold on, there's more work to be done. Step 2, profitability. Now let's suppose that you actually manage to get your hands on a cheap company. That is a good start, but we can do even better. For example, a company can provide its shareholders with great profits, dividends and repurchases, and that is only possible if that company is generating great returns on its assets. And truth be told, a high return on assets tells us that the company is actually doing pretty good. Let us just say that Carter owns a cafe, but he actually paid a gigantic sum of $1.8 million for it. To put it simply, his asset cost him $1.8 million, but when his cafe starts serving people, it brings some $180K in profits for him. On the other hand, Elise owns a bar in a posh New York neighborhood, which she got for some $4 million. But the bar is also bringing in a profit of $180K for the owner. Now, when you look at both of these options, which business will you actually like to own? Yep, it should be Carter's, right? Carter has a 10% return on assets, while Elise has around 5% of returns. This is the reason why the vice chairman of Berkshire Hathaway, Charlie Munger, has said that over the long term, it's hard for the stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Now, this comment by Charlie underlies that there is absolutely no guarantee that past performances are going to ensure future profits, but still, it is highly dependent on which type of metric you're looking at. But still, looking at the historical ROA might be a good indicator for the future ROA. Now, this discussion brings us to a critical junction. Step 3, growth. It goes without even saying that numerous stock market investors think that growth is the most important factor to be considered while looking at stocks. Now, if you had some supernatural power to tell the future, it would be. The main problem at hand is that the growth stats which we're looking at historically aren't reliable. For example, let's suppose that PepsiCo shopped some extravagant growth of more than 20% till 2020, and you threw all of your money into it. But after 2020, due to some unknown reason, the value went down. We hear such examples every day in the stock market. All companies are indeed bound to face some growing pains. It should be understood now that for growth, it is true that past performance is no guarantee for the future, and historical profit growth is even less reliable than historical revenue. We can compare this with the ROA comparison earlier. Whether you're going for historical growth, revenue, or ROA, it should be understood that the stock should be chosen by considering all factors. Now, this further shrinks the circle for our stock selection. That brings us to the fourth step, and that is reliability. So in just a matter of a few minutes, we've been able to narrow down hundreds of stocks into a group of few stocks, which are better than average opportunities. And if you want the list to further shrink, you can simply increase the threshold for the variables we discussed. One thing you surely would have noticed is that probably all of our hypotheses is based on earnings. So the next major step is to check the reliability of these earnings. Our ability to go through the financial details of any company actually matters a lot, and it is often underestimated. For example, if you can simply select a metric, any standard metric for yourself, you can simply select companies with reliable financial situations, manageable debt, stable payout, etc. Step 5, looking deep. Depending on your level of ambition, there are important things to be evaluated over here. We can pretty much find filings of all the companies out there, and if you go deeper on certain platforms, you can even find lists of inside ownerships and recently made insider transactions. It's all about diving deep into the area. Relying on some traditional and old methods for your research might just enable you to be just another sheep in the herd. Remember that the majority is not always right, and contrarianism is the hallmark of an intelligent investor. Finding great stocks to invest in is just another step in your journey to stock market success. But everything starts when you decide to get out of the rat race the educational system has put us in. It all depends on your will to make it out of the ordinary, and for that, you need to have a strong foundation. Start by analysing some basic stock categories which can go a long way in your investing journey. You don't have to go hunting on Google to research about them because we've provided a free ebook in the link given in the description below. Check out the video we handpicked for you, and we'll see you in the next one.